Many traders struggle to find consistent success, not because they lack intelligence or sophisticated tools, but because they're fighting an internal battle. This struggle, often fueled by fear, ego, and unrealistic expectations, is the real roadblock to consistent profitability. Consider two traders who started with the same capital and system. Trader A, brilliant and analytical, mastered every indicator. Yet, after 5 years, his $10,000 became $3,000. Trader B, however, spent 2 years mastering his mental fortitude after 6 months of learning a simple system. 5 years later, his $10,000 had grown to $250,000. Why such different outcomes? Mark Douglas, after 18 years of research with countless traders, found profound truth. Consistent winners differ from others not in market knowledge, but in how they think. They have a unique mental structure that lets them trade without paralyzing fear or destructive recklessness, eliminating common, fear-based errors. Essential lessons for a winning mindset. The path to consistent profitability is mainly an internal journey. It demands a fundamental shift in how you perceive things and a disciplined approach to managing your thoughts and emotions. The paradox of being right. The human ego craves certainty, making the desire to be right a deeply ingrained psychological need. In trading, this desire is a dangerous and often fatal pitfall. The market is a dynamic, complex system that can do anything at any moment due to countless factors. News, massive orders, algorithms, or millions of participants can instantly invalidate even the most meticulous analysis. Believing you know what happens next is one of the most dangerous beliefs a trader can hold. It fosters rigidity, leading to surprise, disappointment, and emotional reactivity when the market inevitably defies your prediction. Successful traders, conversely, embrace this inherent uncertainty. They react to the market's unfolding reality rather than trying to impose their will. Their analysis shifts from seeking certainty to identifying probabilities. They understand that every moment is unique and past outcomes don't dictate future ones. By letting go of the need to predict, they free their minds from rigid expectations, remaining flexible and available to opportunities. The cycle of doom. The initial thrill of winning trades can be intoxicating, creating a carefree state where trading feels effortless. This can lead to the dangerous conclusion that trading is easy. However, this carefree state is often shattered by the first significant loss, one that truly hurts and makes you question your abilities. Suddenly, the market feels like an adversary. This painful experience often triggers the cycle of doom. The typical response is to seek more knowledge, believing that more information will prevent future losses. You dive deeper into indicators and systems. But here's the paradox. The more knowledge you gain, the more you expect from the market. And the more you expect, the more the market disappoints you when it doesn't conform to your analysis. Each disappointment fuels a further quest for knowledge, creating even higher expectations. This cycle doesn't lead to better trading. It leads to more sophisticated fears. The fear of being wrong, the fear of losing money, the fear of missing out FOMO, and the fear of leaving money on the table. The very knowledge sought for protection becomes a source of paralysis and self-sabotage. The mental environment. Douglas discovered that your mental environment acts like a powerful lens through which you perceive and process all market information. Just like a computer's operating system dictates how it handles data, your internal framework of memories, beliefs, attitudes, and expectations determines your trading reality. Every trading experience, especially a painful loss, creates a memory charge with emotional energy. These memories solidify into beliefs about how markets behave. Breakouts are dangerous. This pattern always fails. These beliefs, in turn, create attitudes that color your perception, generating expectations about future outcomes. Consider this deadly process. You take a trade that results in a painful loss. Your mind, instinctively trying to protect you, forms a belief: breakouts are dangerous. This belief creates a cautious, even fearful, attitude towards subsequent breakout trades. This attitude then generates the expectation that the next breakout will fail. When you see a new breakout setup, your expectation of failure causes you to hesitate, enter late, place your stop too close, or exit prematurely. The trade fails not because the breakout itself was flawed, but because your fear-based execution sabotaged it. This failure then reinforces your initial negative belief, strengthening the destructive cycle. You are not trading the market. You are trading your beliefs about the market. Furthermore, our minds have sophisticated mechanisms to shield us from painful information. Consciously, we might rationalize or justify staying in a losing trade. Subconsciously, our minds can automatically alter, distort, or even exclude information from our conscious awareness. This means you might not perceive market signals that contradict your fear-based beliefs, trapping you in self-defeating patterns. The market owes you nothing. This truth can be difficult to accept, but it is profoundly liberating. The market doesn't owe you anything. Not a single penny, not a winning trade, not even fairness. When you experience a loss, it's tempting to externalize blame. The market took my money, or the market stopped me out. However, the market did nothing to you. It simply facilitated a transaction, a transfer of money from your account to another trader's. Trading is a zero-sum game. Every dollar you make comes from another trader's loss, and every dollar you lose goes into another trader's pocket. The market is a neutral, impersonal mechanism for price discovery and wealth transfer. It doesn't care about your analysis, your needs, your hopes, or your dreams. It merely reflects the collective actions of all participants. The liberating aspect of this truth is that if the market isn't doing anything to you, then you possess complete power over your results. You don't need the market to change, nor do you need specific conditions to be present. You simply need to change how you think about and interact with the market. Taking responsibility means acknowledging and accepting at the deepest level that you and not the market are entirely responsible for your success or failure as a trader. This radical acceptance empowers you to adapt and thrive regardless of market conditions. The 5 fundamental truths. Mark Douglas identified 5 universal truths that, when fully accepted and internalized, have the power to dissolve fear and revolutionize your trading. These are not just intellectual concepts. They are principles to be felt and embodied, transforming your perception of the market. Anything can happen at any moment. This is the bedrock truth. No matter how strong your analysis, how certain you feel, the market can always do something unexpected. Complete acceptance of this prevents surprise and emotional reactivity. You don't need to know what happens next to make money. This contradicts the common belief that prediction is key. Just like a casino doesn't know which specific bet will win, but profits consistently. Your focus shifts from predicting individual outcomes to executing your edge consistently over a series of trades. There's a random distribution between wins and losses for any given set of variables that define an edge. Your system might have a 60% win rate over hundreds of trades, but the sequence of those wins and losses is entirely random. Accepting this prevents emotional swings based on short-term results and allows you to trust your edge over time. An edge is nothing more than an indication of a higher probability of one thing happening over another. An edge is a statistical advantage that manifests over a series of trades, not a guarantee on any single trade. This crucial distinction frees you from the pressure of individual trade outcomes. Every moment in the market is unique. While markets show patterns, no 2 moments are the same. This challenges our mind's tendency to categorize, encouraging us to trade what is rather than what was. When you truly internalize these 5 truths, fear becomes impossible. How can you fear loss when you've accepted that anything can happen? This acceptance isn't resignation, It's liberation. The dog story. How your mind creates your reality. This powerful analogy perfectly illustrates how our minds can sabotage our trading. Imagine a child's first encounter with a dog, resulting in a severe bite. Months later, the child sees a friendly dog, but perceives a monster. His body floods with the same terror. He literally cannot see the friendly dog because his fear-based expectations filter out contradicting information. This is precisely what happens in trading. Your last losing trade is like the first dog. It creates a painful memory. The next similar setup is like the friendly dog, different in reality, but perceived as identical through your fear. You cannot see the valid opportunity because you are blinded by projected pain. Your mind automatically associates current market patterns with past painful experiences. This is why you freeze, enter late, exit early, or avoid valid trades. You are not trading current market reality. You are trading your traumatic memories projected onto neutral price movements. Until you understand and address this unconscious projection mechanism, you will remain its prisoner, seeing danger where only opportunity exists. Think like a casino, not a gambler. To achieve consistent profitability, you must adopt a mindset of a casino owner, not a gambler. A casino owner doesn't worry about individual wins at their tables because they understand probability. Over millions of bets, their mathematical edge guarantees profit. Individual outcomes are irrelevant. The law of large numbers is inevitable. Now, observe the gambler. He obsesses over the next hand, his emotional state swinging wildly with each outcome. He searches for patterns in randomness, believes in hot streaks, and thinks he can influence outcomes. Which mindset do you bring to trading? Do you obsess over the next trade like a gambler? Or do you execute your edge with the calm certainty of a casino owner? Do you celebrate and despair with each outcome? Or do you remain emotionally neutral, knowing probability handles the results over time? Professional traders think like casino owners. They understand their edge manifests over hundreds of trades, not the next trade. They don't predict or hope. They execute their system mechanically, letting mathematics handle the outcome. The three sacred rules and the mechanical stage. Mark Douglas identified three non-negotiable rules that distinguish professional traders from gamblers. Violate any of these, and you essentially believe you can predict the future. Always predefine your risk before entering a trade. This means knowing exactly how much you are genuinely willing to lose and accepting that potential loss. If losing that amount would cause emotional pain, you are risking too much. When you predefine and accept your risk, the fear of loss disappears. Cut your losses without hesitation when the market touches your stop. No questions, no second guessing. When your stop is hit, you exit. Period. Your stop loss represents the point where your edge no longer exists. Staying and beyond this point is pure gambling. This rule is hard because exiting a loss triggers psychological pain, but your stop loss is the boundary of your edge. Have a systematic way to take profits. Hope is not a profit strategy. You must have objective rules for capturing gains. Without systematic profit-taking, emotions will control your exits. You need mechanical rules that remove emotional decision-making, ensuring you capture gains according to your plan. These three rules form what Douglas calls the mechanical stage of trading development. You must become a trading machine. No interpretation, no discretion, no creativity. Just pure, robotic execution of your rules. Only after mastering mechanical trading can you safely add elements of intuition. Most traders try to skip this crucial stage, which is why most fail. Commit to being mechanical for your next 20 trades. This is how you build the neural pathways of professional. Dissolving the four trading fears. Douglas identified four primary fears that consistently destroy trading accounts. Understanding their roots and actively dissolving them is essential. The fear of being wrong. We often equate being wrong about market direction with personal failure. In trading, being wrong is a statistical inevitability and a business expense. This fear causes hesitation, late entries, and poor risk-reward ratios. The fear of losing money. Losing money feels like losing security or possibility. This fear manifests as excessively tight stops, premature profit-taking, and paralysis. The solution: only trade with money you have mentally written off. If you can't afford to lose it, you can't afford to trade it. The fear of missing out. FOMO, watching the market move without you, feels like money being stolen. This fear drives impulsive chase entries, overtrading marginal setups, and revenge trading. Remember, the market offers infinite opportunities. Missing one means nothing. The fear of leaving money on the table. You exit a trade with a profit, then watch the market continue significantly in your direction. This fear causes traders to hold winning trades too long, re-enter positions, and abandon profit rules, often turning profits into losses. Truth: you can never capture entire moves. Try and do so guarantees giving back profits. The master key that dissolves all four fears is complete acceptance of risk. When you truly accept that you might be wrong, lose money, miss out, or leave profits on the table, these fears simply cannot exist. This acceptance isn't resignation. It is profound freedom from emotional tyranny, allowing for clear, objective execution. Inside a professional trader's mind, how does a consistent winner trade? Consider Sarah, a professional. She begins her day not by frantically checking the news, but by calmly reviewing her meticulously developed rules. This ensures her decisions are based on objective criteria, not fleeting emotions. Professional traders operate with profound detachment from individual trade outcomes. Each trade is just one event in a series, and their focus is on consistent execution of their edge over the long run. They embrace uncertainty, manage risk meticulously, and adhere to their rules with unwavering discipline. Their minds are free from internal conflicts, allowing them to perceive opportunities clearly and execute flawlessly, regardless of whether the last trade was a winner or a loser. They've cultivated a mental environment where fear and recklessness are virtually eliminated, replaced by a calm, confident, and probabilistic mindset. What steps will you take to cultivate your winning mindset?